Well, howdy there, folks. We have two companies reporting earnings this week, and I'm going to tell you if these stocks are set to blast higher or not, in my opinion, what analysts are expecting for these two stocks, and my expectations for these two stocks. So we're going to be going over here at the top of the video Shopify, which is reporting earnings on Tuesday, and Honest Company, which is also reporting on Tuesday. Honest is a $4 stock. Shopify is an $87 stock. These are both stocks I personally own, so I'm going to tell you my expectations here in regards to these stocks. Okay, then I want to react to a few videos up here. First one up here, Tom Lee, talking about small caps could outperform by more than 100% the next few years. So that should be an interesting one to react to. Dan Niles went on CNBC. He spoke about basically how you should be positioned in this market. So I want to react to that one. And then last reaction here is from BlackRock's Rick Rieder, talking about the technicals of this market are setting up phenomenal, and it bodes very well for the next few months. So I want to react to all those. Appreciate everybody joining me today. All I ask in return for this video is one favor only. Hope it's not too much to ask. It's smash that thumbs up button, hit that thumbs up button. If you want to be subscribed here to the channel, you can subscribe. We hit a new all-time high subscribers in the history of the channel. Appreciate everybody joining me as always. Additionally, pin comment down there if you're looking to access all my premium courses, all those, plus my Discord chat, all that good stuff. Pin comment down there. Click on that, fill out a form. We'll see if we can get you access to all that this upcoming week, okay? So let's start with Shopify first, then we'll get into Honest, okay? So where I always kind of want to think about if I'm trying to judge how I'm feeling about a company's coming earnings is, does this company usually beat on their earnings or do they usually miss? Well, when it comes to Shopify, 1, 2, 3, 4, 5, 6, 7, 8. 8. Don't hate, appreciate, be great, never be late for your date. 8 straight quarters the company has beat on earnings per share and revenue. So what do I think about that? I think if I had to guess, Shopify is probably going to beat their earnings. I mean, this company comes in and beats earnings time and time again. They had one fall off period after, the crazy Rona cycle happened, right? Which hit them hard. But other than that, the company usually beats their earnings per share estimates and their revenue estimates. So even if you knew nothing about this company and nothing about their business model, given the company just continues to beat, you got to assume this company is going to come in and beat their revenue expectations and their earnings per share expectations. Now, the additional thing I want to look at here is, what do they usually beat bigger on? Is it revenue or is it earnings per share? It's clearly earnings per share. The beats for earnings per share are much more substantial on a percentage basis than on revenue. Why is that? Well, let's think about this logically. Shopify is a very heavy subscription business model. So the likelihood that Shopify is going to have some monumental beat when it comes to revenue, not very likely, because a huge chunk of their revenue is from subscription services, people being signed up for their plans and those plans just renewing. Businesses, small businesses, mid-size and large companies as well, right? And so there's just not, maybe they could have a few more people sign up for Shopify. Maybe Shopify Pay has, a little more transactions going through it, things like that. But for the most part, it's very difficult for this company to have a monumental beat on revenue. So if I had to guess, they're probably going to slightly beat on revenue and probably have a very nice beat in regards to earnings per share. Now, this past quarter, they did 26 cents of EPS on just over $2 billion of revenue. Okay. Now, what are analysts expecting here for Shopify? So 27 cents, so very, very slight growth over the previous quarter, because previous quarter is 26 cents, right? And then as far as revenue goes, 2.11 billion, 23% revenue growth. So my guess is they slightly beat on revenue. Maybe they do 2.12 billion, 2.13 billion, maybe 2.14 billion, something like that. Very slight beat on revenue. Earnings per share, my guess is they probably do between 28 cents and 30 cents on earnings per share, okay? So I'm expecting slight beats there. Now, is that enough to get Shopify stock up in a substantial way? Ooh, I don't know. They're going to have to come in with an insanely strong guide if this stock's going to, let's call it make a big move. And when I say big move, I'm talking go over $100 a share. They would have to have some sort of monumental guidance. I'm not necessarily expecting that, so I don't know. Like, for me, I'm kind of expecting Shopify to stay $80 to $90 range. That's also kind of my hope, because I'm not done buying Shopify shares. There's a stock I own in the Patreon portfolio, and I would love to continue to add shares to this one overall. Now, another thing I want to show you guys here that I think is very important in regards to Shopify stock, right, is this stock is still down significantly. Many of the tech stocks, especially a lot of big tech stocks, they've now set new all-time highs, right? And some of them have gone to much higher all-time highs than they were ever at previously. Shopify is still a mile and a half away from an all-time high, right? This stock reached an all-time high back in that late 2021, like all the other tech stocks did, right? And the stock was around $170 at that particular time frame, right? And today the stock is $87. So if you're thinking about one of these great tech companies that still has a long runway of growth to get back to that all-time high, it is Shopify, right? So my guess is they do that over the next 1 to 2 years, and you'll see the stock set a new all-time high. Now, the one thing that kind of sucks in regards to Shopify is the stock trades rich. Forward P on the stock of over 70, 2-year forward P is over 60. Now, keep in mind, analysts are probably too low with their EPS projections. So the reality is a forward P is probably, my opinion is, the forward P is probably in the 60s. The 2-year forward P is probably in the 50s, right? Which is still very rich compared to the market in general, but also keep in mind, it's kind of seen as more of a SaaS type play, right? Because of their recurring revenues. And additionally, the company has great growth rates. Like, how many companies can you count on growing revenue 20%, if not over 20% a quarter? Very few. Shopify is one of those very few. So therefore, it's always going to command a premium valuation. So Shopify is going to be a frustrating stock for people over the next decade because you're likely going to see Shopify go up and up and up and up and up. And the company's probably going to end up becoming $1 trillion company long term, right? It's a little over $100 billion market cap. It'll probably be a 10x opportunity over the next decade. And so it's going to be a very frustrating stock because people are going to want to own it. It's a great company, and it's probably going to be a $1 trillion company someday. But people are always going to look at it and say, it's so expensive. It's so expensive. It's so expensive. And they're going to keep saying that for the next 10 years. And so it's one of those stocks, you just got to buy it. You got to own it. And you kind of got to put valuation over there on the side. And you got to say, this is a special company with special growth rates and a special business model that I just have to own, right? And keep in mind, Shopify is going to continue to innovate on new products and services over this next decade as well. Toby's going to keep the pedal to the metal in regards to that company. It's a very special company with a phenomenal workforce. So they got the right DNA at that company, continue to expand this company rapidly over the next decade, right? So the moral of the story is in regards to Shopify, regardless really what happens on those earnings in terms of the earnings reaction, it's a buy. It's a buy, man. And it trades rich. Guess what? It's going to trade rich next year. It's going to trade rich the following year and the following year and the following year in a long time in the future until someday Shopify has less than 10% revenue growth per year. That's when the company will trade at much lower valuations and will probably trade at a PE of whenever Shopify is less than a 10% revenue grower, that will be when Shopify trades at like a 30 forward PE, because then people just kind of look at it as a consistent SaaS play without the big growth anymore. When you got that 20% plus revenue growth, you command different type of valuations, and that's where Shopify's at, right? Now, in regards to Honest Company, by the way, Cava's also reporting, which I think is worth mentioning. Cava's reporting earnings. You might say, why don't I want to own a stock like Cava? I actually like Cava. I went there when I was in New York City over the summer. Good place, Mediterranean type food, I guess you'd call it. Kind of Chipotle type vibes. Good spot. But that one, the valuation's so ridiculous, I can't own it. And at the end of the day, would I rather own Cava at just, 2-year forward P of 400 or Cheesecake at a forward P of 13? And Cheesecake has two growth concepts behind them. One, Cheesecake has an ATM behind the business, right? In Cheesecake Factory, Cava doesn't. Cava has no ATM, right? Additionally, Cake has two growth concepts on their hands, North Italia and Flower Child, whereas Cava has one growth concept. So given that I get an ATM printer, I get a great dividend, and I get growth on two concept fronts rather than just one with Cava, Cheesecake's, like if I have to put new money into a stock, there's no question Cheesecake's a stock. And I also believe that Cheesecake will significantly outperform Cava stock over the next 5 years and 10 years. Now, over the next 6 months, the next 5 months and 10 months, I have no clue. Maybe Cava's does better than Cheesecake over the next 5-10 months. That's just throwing darts at dartboard. But over the next 5-10 years, there's no doubt in my mind, Cake will significantly outperform Cava. Because Cava's going to have to work through this valuation crisis that's on that stock right at a 400 2-year forward P. And that's going to be a whole situation to work through, right? Because they have to grow so much just to get to where people can understand the valuation there. Now, Honest is reporting, this has obviously been a very hot stock. I mean, a very hot stock. You don't usually think about Honest as a hot stock. The stock has performed tremendous over the past year. It's up 265 flipping flapjacking percent. Now, in regards to Honest here, check this out. So, the company has beat 4 straight quarters under Carla when it comes to earnings per share and revenue. Now, this is really monumental for Honest because prior to Carla running the show here, the company was nothing but a disappointment. They look at the Reds. Miss. I mean, it's just depressing. It was depressing stock tone. All the company did was miss earnings per share quarter after quarter after quarter, right? And sometimes they were missing on revenue as well. Carla has completely turned this company around. And now the company consistently beats on earnings per share. They consistently beat on revenue, right? Now, the revenue beats are not usually massive beats, right? There, look at the beats as far as revenue goes. 11 mil, 4 mil, 3 mil, 6 mil, 3 mil, 6 mil, right? The earnings per share beats are pretty nice. A 3-cent beat, a 9-cent beat, a 7-cent beat, and a 1-cent beat. So if this is another one of those stocks that if you're wondering where's their biggest opportunity to beat on, it's earnings per share. That's their biggest opportunity. So the latest quarter, they had negative 4 cents of EPS, and they had 10% revenue growth with $93 million of revenue here. So what are analysts expecting for this quarter? They're expecting negative 3 cents of EPS. They're expecting $92 million of revenue with about 7.6% growth here. Okay. So when it comes to EPS, I could see them coming in line or maybe beating by 1 cent, maybe coming in with a 2 cent loss rather than 3 cent. Now, if this company comes in and reports basically an even quarter, meaning they don't lose money, they don't make money on the bottom line, I think the stock's going to 5+. If they come in with a profitable quarter, it's going to shock people, and then we're going way over 5. Then we might head to 550. Maybe even 575. If that were to happen, because then people are going to be like, oh my gosh, then people will stop viewing Honest as even a bottom line loser, and they'll start viewing it as a money maker, which means those cash flows start to really build out, the net income starts to really build out, the cash balance starts to build out in a substantial way, and you're talking about a totally different company here, right? Now, additionally, if they come in and beat on that revenue, let's say they come in with a 10% number again, we're also going to blast higher in the stock, and we'll be out of the gulag, and we're going $5 plus, and probably heading to 550, 575 in the short term here. If they can do 10% plus. And here's why. Because when you looked at that latest quarter, right, they did, they as far as revenue went, right, where's our revenue? There's our revenue. Revenue was 10% the last quarter. So if they came through with a 10% number and a 10% number, and remember, that would make it 3 of 4 quarters in a row that they had 10% plus revenue growth, right? If they somehow did that, once again, we're blasting to $5 plus, if not 550 in regards to this one. Now, do I see any significant downside for Honest if these numbers came in bad? The only way I see significant downside, when I say significant downside, I'm talking the stock goes under $4, it would have to be a situation where the loss, the EPS loss, is 5 cents or more on bottom line. And it would have to be a situation where revenue growth is, I would say, under 5%. Maybe they come in with a 2% number, 3%, something like that, when analysts are kind of at 7.7% here. So if either of those situations happen, then you have to worry about Honest stock in the short term and it going back under $4 and then getting out of the gulag in this year away, right? So, but once again, Carla beats and beats and beats, 4 straight quarters of earnings per share growth, 4 straight quarters of revenue beats. So I feel pretty comfortable going into these earnings in regards to Honest, right? And then in terms of the guidance, the guide is not crazy here. I mean, analysts are at $96 million, 6.7% growth there, right? And they're at 2 cent loss in that December quarter. So I think the number set up pretty well. And so the setup here is Honest gets out of the gulag, which is always something I imagine could happen this year. And it gets out of the gulag, we go back over $5 before the end of the year, and then, maybe we head to 550, 575, and then we start to see where the first quarter number's at. If first quarter numbers are a banger, and we're profitable on the bottom line, right? And, let's say we do $100 million plus of revenue in the December quarter, then we're blasting higher. Then we can talk about $6 and $7 being on the table. So the moral of the story is Carla's doing a great job. She's turned the ship around. Now just the question is, Are we getting out of the gulag? And if we're getting out of the gulag, how far are we going in regards to this one, right? Because if we can get this company back to being a profitable company quarter in and quarter out, meaning this EPS number is a plus every quarter and not a minus, and if we can keep this company at a 5 to 10% revenue growth rate, then the stock's changed forever and we're heading back to double digits on the stock. That's all we got to do. It's not like Honest has some ridiculously high set bar here that it's like, oh man, this is going to be so hard for Honest to do this, right? If the company just gets back to profitability every quarter and 5 to 10% revenue growth every quarter, I'm telling you, we're going back to double digits on this one. We'll be back to a $10 plus stock. So we'll see how it sets up. The conference call is going to be very important in regards to that one as well. So definitely looking forward to that. Alrighty, let's get into these videos to react to.
Advisors, Chief Investment Officer at Fundstrat Capital, and the list goes on and on. Andy's a CNBC contributor, first post-election appearance that we've had. You knew Trump was going to win. Well, not many people did.
Yes.
Hey, what about my respect? I knew he was going to win. I called it out in videos time and time again, and I also told you, popular vote, don't be surprised. People are like, that's never going to happen.
I'll give you credit. Are you saying you didn't? Maybe you didn't say it in so many words, but you said it.
Yes, I'd say that we were placing a lot more weight on what the betting markets were pointing to, and so and we, when we look at all the deltas,
and you saw it in the Trump trade,
yes.
And you saw it in Bitcoin,
right?
And you saw it in sectors of the market that would benefit from.
That's right.
Presumably, but who knows from a Trump presidency? So 1,500 points out of the gate. More to come, or are we're already there?
I think we need to respect this move. I mean, there was a tremendous rally post-election, and it continued yesterday.
It was tremendous.
I think it really does reflect a lot of money was taken out of the market because of the uncertainty around the election. And now we know that because of policy changes and animal spirits, that this is really going to benefit things like Bitcoin and small caps and regional banks and financials. So I do think there's still a lot of upside. I mean, small caps trade at 10 times median forward earnings. I mean, that's a...
So what do you think that should be?
Yeah, I mean, it was a tremendous... I mean, if I went back last week, if I recall, the public count was 2.4 million, if I recall. And at the end of this week, it got close to $2.8 million. So just a monumental move in just 1 week.
What's the opportunity set in your mind?
Well, since 1987... small caps traded on a median PE basis at a premium to the S&P. The S&P is at 17 times. So I think small caps could, in the next couple years, outperform by more than 100%.
And what do you think about some of the macro issues that I think create a different level of uncertainty? We keep talking about the bond market and what that might be saying, what you think is happening with gold.
If the market continues to rally into year end, which is, I think, a lot of people's assumption, market's usually great November, great December, especially after elections. If the market continues to rally into year end, right, and then you get kind of that January optimism, I think the returns for the S&P 500 in general set up not very good for the next few years. I really don't. But that doesn't mean the stock market has to crash. And that's the thing people got to understand. A lot of people are of the assumption, like, if the stock market doesn't go up a bunch over the next couple of years, it means it has to crash. It doesn't work like that. You could easily see rotation. And you could see rotation from a lot of the big tech stocks, and you could see a lot of the big tech stocks just flounder. They don't go anywhere. They don't crash. It's not like, oh my gosh, those tech stocks fell 50% like they did in 2022, right? You could see them just flounder around and just kind of be range bound. They're going up a little bit, they're going down a little bit, up, down. They're not going anywhere, right? They're just keeping their feet in place, just moving, and they're really not going anywhere, right? And then you could see a lot of rotation into, like Tom Lee talks about here, a lot of the Russell 2000 type stocks, a lot of the small cap type stocks, right? A lot of the dividend stocks, the value stocks. And so money just kind of rotates out of those big techs. It doesn't cause them to crash. It just kind of rotates into a lot of these other stocks, right? So that could easily happen. And keep in mind, when it comes to these small caps, the moves can be monumental. When just a little money's flushed into them, you don't need crazy money flushed into them.
Vigilante is going to be this governor on whatever you think is going to happen in Washington?
As James Carville famously said, the bond market is, everyone's scared of the bond market. So that is something we need to watch. But we've had plenty of periods where stocks have risen with bonds rising. And I kind of agree with Powell's assessment that it's not yields have gone up not because of inflation, but because there's sort of a change in growth expectations.
I thought that a sweep was, for either party, was the death knell for the markets and frightening to all involved. And now we're getting a sweep. Why isn't it more frightening? Maybe the sweep the other way would have been a little more frightening to some.
Yeah. I mean, I think part of the reason investors are getting somewhat optimistic is that President Trump is entering office again, but this time with a lot more knowledge of how to build a cabinet and a team. And so in some ways, this would end up being more market friendly. And I think that's why investors are becoming optimistic. I mean, I kind of agree with the idea that there are animal spirits growing.
He'll never be deficit friendly, will he? I mean, he will be deficit friendly. He won't be, if we cut taxes on tips, Social Security, overtime, remove the SALT cap, extend the tax cuts. If you do all those things, that seems like
it's going to be very difficult to fix the deficit with just changes in taxes and spending. But it's probably why Bitcoin is kind of interesting here, because it's potentially a treasury reserve asset. And, if Bitcoin rises in price, it actually helps offset the liabilities, which is the deficit.
So you were at 150, I think, on Bitcoin, weren't you? But
yeah.
Not necessarily by the end of this year, or?
I think six figures is still possible before the end of the year, yeah.
And then before the end of the year, 100,000 plus on Bitcoin. Yeah, it's very difficult to cut in that deficit in any major way, especially when it comes to cutting spending. Because if you look at spending of where actually all the money's spent in the United States, like the far majority is spent in three ways. Defense spending. Is Trump going to magically just cut defense spending in some substantial way? It's a potential, but I would call it a little bit more of a long shot. Social Security. Is Trump going to magically say, all the seniors are screwed? No, that ain't going to happen. Medicare. Is that going to is he going to make any magic changes there? No. So therefore, I think it's really tough to cut spending in a substantial way, because that's where almost all the money's spent. Like the only major changes you can make is in those three areas. Because if you look at the pie chart of where the money actually goes, is in those three places. So difficult, very difficult to cut any of those three.
More next year and the year after.
Yeah, I think because now post halving and now Bitcoin's becoming a lot more relevant, and I think maybe the regulatory overhang is diminishing, that there's a lot of upside from here, yes.
Okay, S&P, end of next year.
Well, between now and year end, 5 to 10% is probably the base case, just because that's the type of rally post-election, and we have a dovish Fed and the normal seasonals.
Yeah, if we get another 5 to 10% before the end of the year, I'm just telling you, we're not setting up good as terms of the market in general. Once again, that could mean small caps could still be booming. Dividend value stocks could be great plays in 25, 26. But I'm just telling you, in terms of if you're thinking about the S&P 500 making another great move next year, good luck. If you're thinking about the QQQ making another great move next year, good luck. If we get another 5 to 10% rally here in the year end.
Is that the right move right now for the Fed?
I think inflation fighting war is largely over, and the real rate is still too high. So I agree with Fed's view that we need to move towards neutral, which is towards 3%. So I think it is supportive of markets, and business investment has been constrained. So I think these things are positive.
So what about 2000? What's next year? Is that 25? They move so fast. They're like months now, years. So what about 2025? So 5 to 10% more would put us well above.
Yeah, more than 6,000 before year end. I think at least for the foreseeable future.
No recession.
No recession,
and people want you to answer when I ask you a question. So what do you say? 100 on the S&P?
I think well past like 6,700.
No,
sometime next
6,700.
year. Yeah, sometime next year, because
that's another 20%, isn't it?
Yeah, maybe 10, 15. Yeah, because margin debt hasn't really risen in the last 4 months, and the stock market's up. So we know investors haven't been adding risk. And now we have
10% would just be another 590 points, which we could just call 600, which then you're at 6,600. So yeah, it's not what he's predicting there is not crazy.
Stability, and we have continue dovish Fed, and then this election's behind us, so multiple.
But the issue is, he was talking about 5 to 10% into year end, which do some math around this. Then he's talking about 6,700 end of 2025. Okay, if we get 5 to 10% from here into year end, what's that leave you with returns for next year? Do the math. Nothing. Or very little. Very little.
You're pretty
I
bullish.
agree with him. I agree with him if this market continues to rally in a year end. Now, if the market, goes down a bunch over the next 2-3 months for whatever reason, which might not happen, but let's say it did happen, then that throws, then we could talk about maybe 2025 is a good year in the market, right? In terms of S&P and the Qs. But yeah, if we continue to rally this baby the next 2-3 months, the setup's not good.
Pretty positive on the U.S. and fundamentals, yes.
Okay, good.
Alrighty, that's Tom Lee. Some big predictions there. Alrighty, Dan Niles next up.
Founder and portfolio manager. I don't know whether we can get any more definitive clarity or make definitive decisions on tech than on a lot of the things we discuss that we've been discussing in earnest since we found out the results of Tuesday's election. Dan, do you think you have a clear picture of how it's going to play out with tech?
I mean, the great news, Joe, is that we've already had this before. We had Trump for 4 years. We know what he was focused on. It's not any different this time around. And I think the big thing is that I still feel like an equal weighted basket of stocks is the better way to go than this focus on tech. And if you go back to 2016, after the election, the S&P was up 5% from there through year end. But the sectors that led it were energy, financials, industrials that were up 11%, while the S&P was up 5%. The information technology sector was just up 2%. And so I think, and by the way, the information technology sector had been up about 10% coming into the election. So we know where President Trump's focus is going to be. And I think an equal weighted basket of stocks makes the most sense. Within tech, obviously, you have to think about some of the companies differently. I think with Elon involved going forward, things like crypto or AI are going to get a lot more focus. So names like NVIDIA and less regulation, which will help things like Google potentially not getting broken up, obviously should benefit Tesla as they get treated more fairly relative to the unionized big three Detroit automakers. And so I think those are names that you think about and say, that could be a lot more interesting going forward than it was in the past.
What about the I don't know, lack of a better term, the mercurial nature of some of the decisions that it seemed like even the first time around that President Trump would make? Some of it at times it even seemed almost personal against CEOs or owners of certain companies. Do you need to take that into account? Do you think he'll, I don't know, some of the criticism that he may have received, will that be different this time around? Do you think he's learned from the his first stint as president?
Well, I mean, I think Trump is Trump. He's going to do what he's going to do. I think the great thing about this administration, which we didn't have the last time, is you have one of the brightest minds of our era who's really been able to change multiple industries, space, healthcare with Neuralink, obviously EV, and who's very efficient at running these companies involved. And I think having business people being much more involved in the actual way to make the U.S. better in areas like technology and competitiveness against other countries, where other countries are trying to support their biggest companies. In the U.S. over the prior administration, unfortunately, big was bad. And there was more regulations or attempts to break them up, like in the case of Google. And that puts the U.S. at a competitive disadvantage against other countries. And so for me, I feel like Trump learning that, hey, we want more business people potentially involved with this to help figure out how to solve some of these problems is a good thing. And so I think maybe that's one of the things that was picked up.
Yeah, that's fair. That's fair. I really have nothing to add there. The technicals in the equity market are extraordinary.
Level since the summer following Donald Trump's election win and just ahead of tomorrow's Fed decision. For more on where they might head from here, let's bring in Rick Rieder, BlackRock's Chief Investment Officer of Global Fixed Income. It's great to have you on such a huge day like this, Rick. Thanks for being here.
Thanks for having me, Scott. Big day, big night. It was a long night.
What's most on your mind today as you see all of these different asset classes rallying so heavily?
So it's pretty incredible. I mean, first of all, the results were incredible. It obviously raged on through the evening. But the equity market, I mean, this was, if you think about the growth dynamics that are going to persist, an economy that's been already operating at a good level, the growth data that's going to continue to be good, the propelling of the equity market's pretty incredible. And by the way, I mean, beneath the surface, the drop in volatility that you're seeing is pretty, I would say, like you can own equities when volatility drops, you can own some convexity in it. So that's been super exciting today. Obviously, the dollar, and then the shift to the yield curve has been pretty extraordinary. We've been talking about on the show before. The front end of the curve, while yields are backed up, it still is carrying really well. So that shift in the yield curve has been, I think, rightly so, steepening out quite nicely.
I mean, did we just pour gasoline on the bull market and throw a match on it? I mean, what has actually happened here within the last, I don't know, 12 hours?
Yeah. So, I think the last time we were on the show, I said I don't really like multiples. But it feels like we're long and we like equities, but it feels like speeding down the highway to try and get to where you're going. It doesn't feel great, but it's probably going to keep going. And there are two things happening that I think are profound. One, the technicals in the equity market are extraordinary. The amount of cash that's out there, and you don't really have any sellers. You don't have any IPO market, and the buybacks are profound. So you have an amazing technical. And to your point, what was challenging is the multiples are aggressive. And you have to count on, to get to the forwards on these multiples, you have to count on significant earnings growth. Well, you just got a kicker of maybe nominal GDP stays considerably higher. And by the way, I agree with the commentary earlier. You got to keep nominal GDP up, and that's how you outrun the debt. But maybe we keep nominal GDP up, and then the earnings, U.S. companies are operating leverage machines on nominal GDP. And so you just got a nice tailwind from that.
Well, I mean, it's good that you agree publicly on television with your boss. He's the one who wrote the piece.
Yeah, so I do. And by the way, it's just straight math. If you say today, so the average cost of debt in the United States about just under 3.5%. If we keep nominal GDP above 4 to 5, you can actually, and then you think about, gosh, there are things we got to do around spending. There's other ways to actually create spend that's got some velocity to it if it's spent on infrastructure, et cetera. If you create that paradigm, it's the only way that you can actually outrun the debt problem in this country. We got to do a couple things. We got to end up reducing the debt, the spend. We got to get the interest costs down, and then ultimately, if you grow fast enough, I mean, it's just straight math that you can actually. But it's the only way. I mean, quite frankly, it's the only way to do it. That's not a pernicious impact on the economy. This idea that we'll just aggressively cut spend, send the economy in a tailspin. It just, you don't get there.
But what do I do with the prospect of higher growth as we spin it now towards the Fed decision tomorrow and what policy is going to look like in 25? All of that obviously has the possibility of leading to protracted inflation, if not a pickup. So how should I think about, the idea that, maybe they're not going to cut even nearly as much as we thought because they're not going to be able to?
So here's the question. First of all, I think inflation, the descent of inflation has already happened. Like, we didn't think inflation was coming down much further or any further from here, no matter what. We think inflation is going to run in the mid-2s for next year. So we think the descent of inflation has come down. So if you're the Federal Reserve today, you think about, I mean, to me, it's a no-brainer in terms of, gosh, you got to get that funds rate down to 4. And if you get the funds rate, so you do a 25 in November, you probably do a 25 in December. Once you get the funds rate to 2, you got inflation at 2.5. And then there's a lot of policy evolution. There's a lot of things they're going to learn. And then you make a determination from there. I don't think it is that much of a challenge to get that rate down to a 4 level, which is still, I would argue, restrictive in many ways. But then it becomes, the question of do you execute the further cuts in the next year? And that becomes questionable. It's part of why I think the front end of the yield curve, which is pricing that today, it's like, wow, there's not a lot of downside in it. If you go further out the yield curve, and then you've got to count on inflation staying down, maybe the Fed cutting more, then it becomes a tougher trade. And again, why I think, owning 30-year treasuries is a bet on term premium, bet on what we're going to do on the debt and the deficit, but you don't need to do it with the yield curve still as flat as it is, even though we've steepened somewhat.
Yeah, I think you're going to have a lot of question marks that come up in really starts around, I would say it really starts around spring or summer of 2025. And these questions are going to start emerging about, first off, what is Trump's approach? Once he actually gets in office and he starts running the show, does he want to take an approach in that first 6 to 9 months of really talking about how bad the economy is and those sorts of things, and really frame things as like, oh, Biden set me up in a really bad position? Then it kind of leads into, what does the Fed do? Like, what happens if the Fed does not lower as fast as Trump wants him to? Does he play that card there, right? From there, I think, and by the way, if he does play that card, that's going to freak a lot of people out. Because let's say Trump is talking very bad about the economy and things like that. I think sometimes that can become a self-fulfilling prophecy. And if people hear the president talking down the economy and how bad things are, then they, make different adjustments. So that would be a whole weird situation we'd have to go through if that happens, right? The problem is, if he doesn't talk like that and he takes over the economy, let's say we have issues in 2026, then he can't put it on Biden then, right? And then people are going to be looking, if we do run into any sort of economic problems in 2026, and they're going to be looking straight at him and be like, this is your fault, right? So it's much easier for him to get in office, talk down things, try to tell the Fed, hey, we need to get lower in rates. Like, we got these problems. This is a problem. This is a problem. This is a problem, right? We need to get lower in rates. Rates are too high on people, things like that, right? So that's going to be an interesting dynamic to see if that plays out. Maybe it doesn't, right? But I think it's a serious potential. And how does the market take that? That should be an interesting whole situation. From there, we're going to have, especially if this market continues to run, we'll have the valuation talk about really like valuation on the market, right? From there, we'll have inflation, right? So inflation's looking great for the next 6 months, if not the next 12 months. But if gas prices start to go back up, let's say spring, summer, which is a real potential, what happens then to CPI? What begins to happen if we start to see a CPI continually increase? How does the market take that? Like, let's say we go down to like a 2% CPI in the next 3 months, which is actually potential. And then we go up to 2.1, 2.2. 2.3, 2.4, 2.7, 2.9, 3.1. How does the market take that? Because if there's something that could really scare the market and get people to freak out, I watched this happen after the great financial crisis. So after the great financial crisis happened, right, market starts to roar back. Then people start talking about this thing called a double dip recession. And this talk started, it was either 2010 or 2011. And people were seriously considering that we were about to go into another recession, right? After we were just trying to climb out of the last recession. And everybody started talking about double dip recession. So that could easily happen again, but this time in terms of inflation. And people would be talking about double dip inflation, but instead of double dip inflation, maybe they'll call it a double scoops. I don't know what though. They'll come up with some fancy term for it. But basically, the revival of inflation again, right? And then what does that mean for the economy? What does that mean for the consumer? What does that mean for the Fed? Does the Fed have to stop cutting rates? Because if that ever starts to happen, right? Let's say the Fed gets rates down to 3.5, 3.75, 3.25, something like that. But then all of a sudden, you see CPI continue to pick up. You see PPI starting to pick up. And all of a sudden, people are like, oh my gosh, inflation's coming back. The Fed's going to have to stop lowering rates, and maybe they have to start raising rates again. Market flips out over that. So things are going to get really interesting, I think, probably starting in the spring next year, but definitely likely in the summer and then the back half of 2025. And so, yeah, right now the market can just run on optimism. Big tech earnings were great. NVIDIA's going to come through with banger numbers when they report earnings. That's 2 weeks from now. They're going to come in with banger numbers. It's going to be smash city in terms of last quarter, next quarter. Jensen's going to be talking up 2025 like nobody's business. It's all going to be just boom, boom, boom. Santa Claus rally. Everybody feeling great. Trump's going to take back over. Obey, right? So we just got a lot of optimism over the next few months. Reality starts to set in the spring and summer of 2025, right? And then people are going to start asking all these questions. And that's when that's when things are going to get fun. That's when things are going to get real interesting real fast. And that's when you'll start to see likely, what's going to come back? The VIX. The VIX going to likely come back. Spring, summertime, into the second half of 2025, the VIX starts to come back to life. And all of a sudden, people are going to start asking all these questions, and volatility is going to get going again. And you're going to start seeing some violent moves in the market, right? So in the short term, maybe we can just drift higher, but the violence will be back. It's going to get real interesting then, right? And as a long-term investor, I just love all these different markets. You want to be in the drift the market higher market, that's fine. If we want to get into some volatility next year, which we probably will, that's going to be fun. That's going to create some unbelievable opportunities out there. So yeah, and I've obviously done a lot of videos on the main channel recently about some of the best stock opportunities I see in the market as far as individual stocks go. If you don't follow me on the main channel, it's called Financial Education. I've done a lot of videos over the past 2 or 3 weeks on some of the best stock opportunities I see in the market. And so if you haven't got to check out the main channel, you might definitely want to do that, okay? Additionally, pin comment down there today will be if you're looking to access my private stock group, get access to all my premium courses, become a master stock market, millionaire playbook, stock options mastery, dividend investing mastery, all my other courses as well, plus my 6 and 7 figure Discord chat with myself and all the other members, exclusive weekly videos. Pin comment down there, fill out a form, see if we can get you access to all that maybe this coming week, okay? All right, guys, much love and have a great day.